Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC. My co-host is Chuck Steege. He is from SFG Management, and Chuck is a certified financial planner, and he's a certified equity professional, and his company is an SEC registered investment advisor. Our special guest tonight is Richard Sichel, the Chief Investment Officer of Philadelphia Trust. It's going to be a great show, so stick with us. Okay, I think we want to talk a little bit first, Chuck, about some of the ways that key executives can benefit. I know there are a lot of qualified plans where the normal employee in a firm can get these big tax breaks, but then there are some non-traditional or non-qualified plans where the key executives can be retained by giving them something extra. So let's talk a little bit about that tonight.
Okay, yeah, absolutely happy to. So senior level corporate executives do have, under the company stock incentive plan, a whole plethora of stock-based forms of stock-based compensation. The most senior level folks will have performance awards, they will have restricted stock, they will have options, they may have short-term cash bonuses that are paid to them. What I really wanted to focus on is the whole concept of the elections that some executives, not so much in the C-suite, but maybe a little bit further down, where they do have a choice in terms of the type of stock-based comp that they can actually choose.
Now, in general, does the company get any kind of tax break from these kind of awards that they give to employees?
Companies do get tax breaks, and that's there's been a lot of accounting rules under, for instance, FASB, where the accounting rules are really driving much of how the company is able to deduct or reduce their taxable income on the income statement. And they will vary depending on the type of plan, absolutely.
Okay, anything you want to bring up, Richard, on that?
You hear stock options, but then you hear qualified, non-qualified, et cetera, et cetera. Can you do a 1 minute explanation of what that is?
Yeah, so a qualified...
Might take more than a minute.
Yeah, a qualified plan is obviously anything that falls under ERISA, where an employee has the ability, for instance, to contribute to a 401k, or maybe they're a participant in a qualified retirement plan like a pension plan. Non-qualified would be anything that falls outside of ERISA rules, and typically a stock-based compensation plan would fall under that category.
Is one better than the other for the employee?
Well, they're mutually complementary. For the company, anytime they're contributing money into a qualified plan, they're able to obviously take a reduction in their, you know, it's an expense, and that's a good thing for the company. And depending on the type of stock-based compensation plan, there's expensing. Actually, with any type of stock-based compensation plan, there's expensing for the company.
Suppose that I'm hoping to be a key executive in a new firm, and I'm offered these non-qualified stock options and restricted stock. Why would I want that versus the normal type of things that the average employee gets?
Great question, and a lot of what's going to drive that will come down to the executives' engagement in the company and what they see are the prospects for the future of the company. So oftentimes they have a choice between, let's say, choosing a stock option or choosing a restricted stock unit, or maybe a combination thereof. So oftentimes what will drive that decision is the perspective that the employee has or the senior level executive has in terms of the future of the company.
Okay. Richard.
So when you advise people, I mean, you're advising on taxability. Obviously the price of the stock is something big, you know, remember Enron and people having that. So, you know, how deep do you get into this?
Well, pretty deeply, and a lot of executives who are trying to decide on the type of plan, they really need to do analysis, and they really need to get with somebody who's qualified and can handle the analysis around their choices. So, for instance, it's not unreasonable for an executive to choose a non-qualified option over a restricted stock unit, if they have that choice, based on the company's stock expected growth.
Yeah.
So if the analysis really requires somebody to look at, well, gee, where is the break even between one of those forms of stock-based comp versus the other? And if the company, let's say, has a 5% expected return, it might be, let's say, 6 years out before there's a break-even point with the options versus restricted stock. Whereas if, let's say, the stock is growing at 10% per year, it might be a 3-year period.
So just quickly, economic factors do matter. If you're coming into a company that's had a big run in their stock, then that might be a concern about what type of choice you want to get. Maybe you'd rather have stock than options, which would rely on the stock going higher.
Absolutely. So typically there's 3 factors that enter into a decision when it comes to choosing either a restricted stock or a non-qualified option. And the first is going to be, what is your perspective about the future of the company?
Yeah.
Are you optimistic or not? If you're optimistic, you're going to tend to favor options over restricted stock. Number 2, how much can you stomach the volatility of the company's stock?
And you've got to get the timing right, because options expire at a certain time. And wouldn't it be a shame if you were right, but the company takes off after your options have expired?
That's certainly, but usually there's a 10-year period. The third factor comes down to when you expect that you're going to need the funds. So if you need the funds sooner, let's say maybe you're trying to fund a child's education, a tuition payment, or you're expecting retirement, and that's going to be on a near-term basis, maybe restricted stock units is a better way to go versus options, where options may take, to your point, Charlie, it may take options a while before they actually realize their value.
All right. Richard, do you have another question before we get into the...
It sounds like timing, as with anything, is very key. You know, get into the company right at that point or a little late, but anybody who gets these options, though, is, I guess, fortunate, and you know, they're key people.
Absolutely.
Gives them a lot of opportunity.
Timing is also important when it comes to the tax event for the executive. So as you know, when an executive exercises an option, that becomes a taxable event.
Yeah.
And if it's a non-qualified stock option, that's going to be W-2 income to them. A restricted stock unit tends to have the tax event at the time of vesting, when that executive has the ability to take legal possession of their funds. So it's going to be W-2 income either way. The real question becomes, how long do you want to defer the tax event?
Okay, well,
in which case the NQO might be better.
Suppose the restricted stock is restricted for 2 years and then it's granted and it could be sold. Does the clock then start running for the 1 year and a day to make it a long-term gain?
It becomes taxable at the moment of vesting.
I see.
From that point on, with any future appreciation, the clock absolutely starts ticking, where if it's 1 year and a day that's held, then it becomes subject to long-term either capital gains or losses, depending on the
Great.
On the
We got
future
some more
of the
ground to
stock.
cover. Let's try to help one of our viewers. Jack Teller of Exton says, when interest rates go up, bond prices go down. What other investments do the same thing?
Richard, do you want to take a stab at that?
Well, when it comes about things going down, okay. I can think of high dividend paying stocks, utilities, and others. And I know there's been a rush to get into these companies for a few years now, and it's a good idea, because you know, money market rates are basically nothing, bonds are a couple of percent, so you know, you can buy some good 3, 4, 5% dividend paying stocks, but keep in mind that the market value might go lower based on either rates going higher or based on the company having some difficulty. So that's one that jumps out at me.
So interest-sensitive stocks can do that, but then there's other factors like currencies and what country they're in and all that sort of thing. So there's no pat answer on this, and that's why we ask our viewers and listeners to please consult their tax advisors for tax advice and and talk to their financial advisor to make sure that they don't just hear something on TV and then misunderstand what's said.
Yes,
all these subjects are worthy of more than a minute.
Okay, for viewers, go ahead.
I'm sorry,
sure,
Charlie.
go ahead,
I would
please.
also add that real estate investment trusts do tend to be somewhat sensitive to interest rate and interest rate fluctuations, so that's an important asset class to consider.
Okay, thank you, Chuck. Thank you, Richard. If you've got a question, we're going to put up a quick video to tell you how you can send in a question, and we'll hopefully be able to get to that question and get it answered.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
You're up.
So as Charlie mentioned a couple minutes ago, our guest is Richard Sichel. Is that how you pronounce it?
Close.
Okay. And you are an executive vice president and a chief investment officer with the Philadelphia Trust Company.
Correct.
Can you tell us a little bit about your role, a little bit about your firm?
Sure, happy to. Philadelphia Trust Company, we're a wealth management company. We manage about $2 billion of assets. About half is what's called institutional, foundations, endowments, pension plans, unions, whatever. And the other half, high net worth individuals, which can be trust accounts where we can act as a trustee or advisor to trustee, IRA rollovers, which come from 401ks, 403bs when people retire. And if it's none of those, then it's regular money. So any kind of money, we're happy to manage it. And we're about half and half institutional and individuals, and we use all individual stocks and bonds. So we're a little quite unique, I think, separately managed accounts, as it's called.
Well, Richard, quite frequently people will say, how should I invest my money? And of course, when you're on a television show, different circumstances dictate how different people should invest. Could you talk a little bit about maybe the difference between a young, aggressive investor and an elderly, conservative investor, and then the middle of the road person that's sort of in between those stages?
Sure. Yeah, we call it the target asset allocation. I don't think we invented that. And basically it's a mix of stocks and bonds that we think is most appropriate for the client. And the one thing that bothers me is when I hear, well, somebody said you subtract your age from 100 and then that's your stock and bond ratio, and I wait a minute. Yeah, everybody's different. We could have somebody who's been retired for 10 years who's mostly in stocks. They may not, they have enough income, it's their risk characteristics that they're not nervous when the market moves. They don't, basically stocks are the best long-term investment, the worst short-term investment. So keep that in mind. But if somebody is, a certain age, they want to have growth, they'll have that growth, and they're good stocks, and they can pass to other people. So there's no rush to bonds unless you want a little more stability in the portfolio. And again, if somebody's 25 years old and they come in with $2 million and say, how should I invest? I need this money in 3 months for a business. I'd say, don't buy stocks.
Yeah.
I love stocks, and they might be higher in 3 months, they might not be, but you don't want to take that kind of a risk. So those are extremes to some extent. Everybody's not 50-50. We have people who are, there are many who are 65-35, 35-65. So yes, it depends on, to some extent, your income, your needs, and really how you sleep at night. And if you can take the volatility that stocks will give you, you will make more money over the years. So, and 2008 was I believe the second worst year ever for the market. It was down 37%. And if you had a mix of half stocks, half bonds, you might have been down 15%, something like that. Not great, but that's very good. and that way your money's ready to grow again. So bonds are very boring these days with the low yields, but they do give you stability and they give you some income. So there's always pluses for both.
Well, and I appreciate your mentioning the word income, because that's certainly very important for a number of investors. We're in a very low interest rate environment. We've been in a low interest rate environment for some time. What options are available to somebody that's in a position where they do need income?
Yes, it's gotten very, very difficult, and the rates have stayed lower longer than I think anybody thought. I'd like to say we predicted. We didn't. We thought rates would be somewhat higher by now.
Yeah.
But you know, you can buy bonds, you can buy good quality bonds, keep them relatively short to intermediate, you know, anywhere from a year, 3, 4, 5 years, and stay with the quality. So don't stretch to get more coupon by going longer, going lower quality. You don't want to do that with your bond portfolio. But what you do get with that type of a portfolio, we may buy you a 4-year bond a year ago at 2.5%, we'll just call it that. And 6 months from now, you know, that bond's going to be a couple of year bond, and rates go higher. We can sell that bond close to what we paid and move out the yield curve, so to speak, and get a higher rate. So you don't want to get locked in. You don't want to buy a 30-year. You don't want to play around with low quality.
Yeah,
And
you
then,
alluded to the comment that used to be 100 minus your age. And of course, our viewers and listeners should be aware of the fact that kind of advice was out there when government bonds were paying 6 or 7%. And you know, for 30 years, rates have been coming down. And that might have been a good rule of thumb. But right now, that's probably not good advice, right? Because with bonds down as low as they've been and artificially induced even lower by the government, there's a risk that you could get a pretty big percentage move back up, and that would really hurt the value of long-term bonds, right?
Yes, and it also happened to long-term bonds when inflation, you know, came along, and people had 6% bonds and 7 back in the late 70s that were 30-year bonds, and some of those bonds lost 30, 40% of their value when inflation went higher. So it goes both ways. Bonds are relatively boring, and you should keep them relatively boring, but keep them liquid and keep them high quality. And then you can look to good stocks. And you know, in our typical portfolio, we have 40, 45 stocks. There are a handful that don't pay dividends. Some of them are tech, and some of them start paying dividends, and that's fine. But you know, there's a group of stocks that yield 3, 4, 5% still, and that's a good bit more than you can get in most fixed income investments. And the nice thing about these companies that pay these good dividends is they can afford to pay it. They increase the dividend typically 8, 10, 12% a year, so you get an increase in the income. And if there is a downturn, they can still pay that dividend. What you have to keep in mind, though, is that the dividend, that a stock can go down. So, so it's not quite, don't be overly comfortable with it, but that can be a good part of a portfolio, and it does provide you good income and income growth.
So the idea of a laddered bond, I know that's something that a lot of investors have looked at as a strategy. Do you want to just comment on how those work? Where would it make sense for somebody?
You know, basically that's having, you know, bond, something coming due every year or certain intervals. And when you buy bonds, you really want to look out and see where you're getting paid the most at that point. And it may be the 4-year bond rather than the 3-year or the 6-year. So it's a little too mechanical to say, let's buy bonds due each year and we'll have something coming due each year. You can go and sort of find better offers, and you'll still, as I say, you have a ladder of sorts. When the 3-year bond that you bought a year ago is now a 2-year, pretty liquid, and you can move out again and get higher rates when the time comes. And you have the income coming in, and you can always sell the bond and sell it for somewhat near what you paid for it.
Thank you.
So we like to put a lot more thought into it.
Just quickly, with rates so low, what kind of percent of principal do you tell people they can take year after year in this environment and still generally preserve their principal? Well,
you know, with IRA rollovers, the federal government, basically there's a calculation, but it's about 4% a year that they tell you have to take or require minimum distribution. And If you're taking something like 4% and again, long-term projections, and you can put whatever projections you want in there, but you want to be reasonable and say, you know, stocks grow 8% a year, 9%, bonds could be 3 or 4.
Yeah.
So if you're taking 4 and you're getting, you know, 5, you can do projections that go out 25 years and you have more money later on. You can even program in some increases, give yourself a raise every year. So we do those types of calculations for people so they can see that. If somebody says they want 10% a year immediately, it's going to be tough.
Okay, thank you. You guys got any questions for me?
Yes, we do. There's obviously been a lot of questions about the expectation for interest rates.
Yeah.
And you know, if we do see an interest rate hike, what's the outlook for that?
Well, I've been, as we alluded to earlier, I've been expecting an increase in interest rates already, and we haven't gotten it. We're starting to see a few indications lately, and I want to remind our viewers and listeners not to time any decisions on this show. It's taped, and they might be seeing the show a week or two after they hear the words. But in general, they just the other day had indications that inflation's picking up a little bit in Europe. The market had a knee-jerk reaction down, but then other statistics came out that said, no, maybe not so much. And so it's a question of asking yourself, if rates do go up, will I be okay? Look at your portfolio from a stress test point of view, that if the 30-year bond goes up to 4.5% from just above 3, or if the 10-year bond goes up from 2.2 or 2.28 up to 3, what will that do to your portfolio? And you might be shocked. Rather than being shocked by reading your statements later after you've invested in those type of bonds, ask your financial advisor, what would the impact be based on my portfolio, and do a stress test.
Yeah, I think people have to be prepared and understand bonds. I think a lot of people, to some extent, understand stocks. You know, they're just easier to understand. Bonds are a world all their own, and I think professionals can add a lot to it, as well as stocks, of course. Okay. But we tend to talk about stocks, or most people talk about stocks most of the time, but
sure,
bonds need to get some coverage too.
So it seems like it's the spring. When spring rolls in, everybody begins to talk about Greece again.
Yeah.
Greece seems to be in the headlines. Do you want to just comment on what you're seeing there and the impact on European stocks?
Well, let me talk about the good news first. It seems like we used to refer them to the pigs, the Portugal and Ireland and Italy and Greece and Spain. Well, the other 4 countries seem to have gotten a little bit of religion as they see what Greece has been going through. And my main comment is I will predict the Germans are not going to be willing to work till they're 80 so that the Greeks can work till they're 60. Now, how that's going to sort out will be a little tough to predict, but that's my fearless prediction.
Mm-hmm. Where are you putting new money today?
Well, if someone brings in a large amount of new money today, I'm trying not to invest it all at once. I feel like the market's had a good run for 4 or 5 years. We've been waiting for a 7 to 10% correction for quite a while. It's pretty rare to have gone as long as we have without one. So I prefer right now to put some money, asset allocate money, some in the US, some overseas, some in relatively short-term fixed income, and keep some powder dry so that in case a correction comes 2 months from now, we'll have some cash on the sideline and that person won't panic and say, what have you done to me? I'm getting out.
Mm-hmm. Do you have some questions, Richard?
Yeah, I think one of the things that I've wondered about is retail sales. You know, it's a big part of the economy. And when gasoline went down, and it's still down, it's come up some, but it's down, you know, there's all this money that is left over that supposedly everybody's going to run out and spend.
Yeah.
And thus far, I don't think we've really seen that. So where is that money?
I'm starting to wonder, is it different this time? I remember in 2008, one of my clients, who's a physician, made a comment to me after the market went down so hard and says, well, maybe my wife will realize she doesn't need to get a $250 pair of sandals every 6 months. So that has kind of stuck in my mind, and I'm wondering if people are going to try to be a little smarter with their money and look for bargains and not be as aggressive as they used to be. And some very well managed stores are having trouble getting customers in and getting rid of their inventory.
Well, and certainly retail sales are driven by the fact that consumers have to feel confident about their resources, and they have been holding back a little bit. You know, the consumer makes up 2/3 of the economy, and they've been holding back a little bit. So,
yeah,
it's a good point. So, part of what seems to be driving consumer behavior in terms of spending are their resources and gas prices. So that leads to the question about commodities. We saw oil drop precipitously, and it now seems to be moving back up. What's your outlook for commodities in general?
Well, in the minute or so remaining, I have always felt like that oil prices didn't belong at $104 and that they didn't belong in the low 40s, that they belong somewhere in this, the price belongs somewhere in the $60 to $70 range. And that's kind of where we have gotten back to. So it won't surprise me if we start to have maybe a slow, steady climb, and then as the economy starts to recover, if it does, and I happen to think it's going to recover faster than some other people think it will, then perhaps we'll see oil prices back up at $75 in a couple of years. But there's so much supply out there, and there's so many people who have their own projects going on that they've temporarily postponed, and as prices rise, I think maybe some of that will come back online and be a dampener effect on a price rise. What do you think, Richard?
Yeah, I mean, obviously the energy situation in this country has been incredible, and you know, the supply was there, and we found it. The other thing is, you know, truck sales are up, big SUV sales are up, so we tend to, as soon as it gets cheap, we forget about it. It gets expensive, then we talk about hybrids. The moment nobody's buying hybrids.
And there we have to stop.
It sort of feeds on itself, and
thank you very much.
Gets you toward the middle.
It's been a great show. Next week we're going to have Mark Mulholland, who's a wonderful money manager. He runs the Matthew 25 fund, and he's always been in the top performing bracket in recent years. It's going to be a terrific show. No guarantee he can do that in the future, but stick with us. As far as we're concerned, your money matters.